Hi, it's John Kelly. In this module, we are going to discuss common sense materiality. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, I call this common sense materiality because a lot of people I see fall into a math trap. And they come to me and they say, well, materiality has to be 5% of net income before tax or 1% of revenues, and can't I make it larger? And what it is they are trapped by the math. So the first suggestion is just don't be trapped by the math. These are benchmarks, these are guidelines, these are things you should toss around in your head, but don't be trapped by the number, don't be trapped by 5% of net income before tax. I will also tell you anecdotally that some auditors are using 5% of revenues, which seems to make for a rather large materiality, and of course we'd like materiality to be larger if we can get away with it. And that's because, of course, if materiality is lower, it's more work and higher cost, and if materiality is higher, it's less work and lower cost. So of course we would like materiality to be higher, so we don't have to do so much work. But on the other hand, if users really expect us to be using a lower number, we're going to get into trouble for that too if we don't do the audit accurately enough to meet the needs of those users. So very important that we pick the right number to match user needs and balance the cost of the audit. Now, when we look at professional standards, there it is, 320A7, 5% of net income before tax, 1% of revenues, and we're stuck. We can't get around this. There are the guidelines, there are the benchmarks, and there's nothing we can do about it. Well, that's not true, and we should not allow ourselves to be stuck in the math. So where else should we look in professional standards? And it's actually not that far away. The last sentence of 320A7 says, higher or lower percentages, however, may be deemed appropriate in the circumstances. And it gives us a hint for owner-managed companies and said maybe we want to use profit before management salaries. So right there is a suggestion that higher or lower percentages are deemed appropriate. And we need to be very careful about that. Higher materiality makes the audit cheaper, and if that is consistent with user needs, fine. But lower materiality may also be appropriate in the circumstances. We should use, for instance, less than 5%, and we need to think about that in the circumstances. So higher or lower is appropriate. We should document our decision and why we thought that was true. And even more important, if we go read the actual standard, not just an appendix, because the standard has more authority than the appendix. And the standard says that determining materiality is a matter of professional judgment based on the auditor's perception of the information needs of users. So that's what we should be doing. The auditor, the partner, should be making a professional judgment based on their view of the information needs of users. And I quote the advice of the Treadway Commission, and they were talking about the application of analytical procedures, but I think these three things that they talked about there, done mechanically, done by inexperienced staff, and done at the end of the audit, can be applied in many audit situations, and those are three bad ways of doing an audit. With respect to materiality done mechanically, well, if you just automatically decide that in every audit you're going to use 5%, you've fallen into a math trap, and your materiality will either be too high or too low, and it won't be right. So don't do that. Done by inexperienced staff, and this is kind of characteristic of the profession, that we try to find a way that the most junior person in the office can do this. If you look at the requirement in professional standard, it's saying that the partner should do this, and it's a professional judgment made by someone with the ability to make a good professional judgment. And if you're inexperienced, your inexperience prevents that. So it should be done by the partner and done at the end of the audit. And I see lots of people still madly dashing to get their planning done just as they finish the audit. And if you're determining materiality at the end of the audit mechanically, well, you're going to just be doing it wrong. And it's got to be done as the very, very first thing you do in the audit, the very, very first part of planning, because the next thing you're going to do is assess the risk of material misstatement. And if you don't know what materiality is, you can't do that properly. So don't fall into the math trap. Have the partner determine materiality. And that should be the very, very first thing done as part of planning and the very first thing done as the audit begins for the year. Now, some examples from the UK where you have to disclose how you got materiality. And of course you should be careful and you should be sensitive to the environment. And of course with public companies you're best on the low end. But two examples that I have seen where companies did much worse in the current year than they'd done in prior years. Materiality was disclosed and set, and it was between 40 and 100% of this year's net income. And the auditor explained that they had used 5% of a normalized net income averaged back over time. And that is certainly acceptable, and that's certainly something else that you can do. Now, there's a hint on the previous slide as to how we can avoid another math trap. And let's consider two people setting materiality for the same audit. And the first person says, well, I'm going to pick 10% of this year's income, which I expect to be $1 million, and 10% of that's $100,000, and that's my materiality. The second person says, well, I'm also using income, but I'm normalizing prior income, and by coincidence that also happens to be $1 million. So 10% of that is $100,000. So we both go into the audit with $100,000 materiality. Both people, however, find and correct a $100,000 error. And the first person now, I suppose, if we follow their math logic along, we're going to have to say, well, we wanted to be 10% of $1 million, and now I guess we have to be 10% of 900,000, and now maybe we have an issue. The second person, their materiality is unchanged because it wasn't based on the current year, it was based on a normalized prior year. And this is a problem because 450.10 tells us that before evaluating uncorrected errors, we have to reassess whether materiality remains appropriate in the circumstances. So the first person has an issue. Perhaps they can resolve it by writing a story or an explanation or some kind of documentation. But the second person is fine. They can say, well, normalized income from the prior years remains at $1 million, and 10% of that's $100,000. And that's what I'd always planned on using, so I'm okay. So with respect to this second math trap, this is going to be more important on a larger audit. You may perhaps start planning in August and do an interim audit in September or October. So you will have set materiality and you will be using it to determine extent of testing perhaps early. But that could even be an issue on a smaller audit when, as in my previous example, income changes. So you really do need to base materiality based on the scale of the entity, not just one number, not just income, and not just income this year, but think about it in the context of the organization. And as long as the scale of the entity stays roughly the same year to year, you're going to be okay doing that. Now, the other thing you got to watch is don't get too complex, because I've seen people take 10% of income, 5% of assets, 3% of working capital, 4% of this, 9% of that, 12% of revenue, all kinds of numbers, do a weighted average calculation and come up with a number. And they've done so much math now that perhaps if they looked at it judgmentally, they would say, well, that number's far too big or far too small given the scale of the entity. So watch the math, don't get trapped up in it. Always reflect back on professional judgment and don't get too complex. So the solution to all of this is to, in fact, use common sense. There's nothing special you've got to do. The standard is, in fact, a common sense standard, and the appendix, indeed, describes a common sense way of doing it and a common sense way of following and using benchmarks. And consider the users and don't fall into a math trap. Be sensitive to the environment you're in. If you're in a public company environment, you're going to want to use a lower materiality. And document, document, document. Be very careful to document all the decisions you made as you determined materiality. So, thanks for listening.